Hello, this is Quanro Invest. Today I'll be talking about some of my highest conviction stocks that I have in my portfolio. So the first stock that I'll be talking about is Google. Google is currently the cheapest Mag 7 now. It is trading at a 22 PE, growing at 38% last year and then projected to grow maybe 15% in the future as well. So if you look at Google, it is currently trading at a 22 PE. You have Meta trading at 30 PE, you have Microsoft trading at 30 PE as well. You have Amazon trading at a 40 PE. You have Tesla trading at 100 PE. So if you look at the Mag 7 as a whole, using relative valuation, Google is extremely cheap. So let's not talk so much about relative valuation. Let's go into the numbers. So if you look at Google's earnings, in the past year, the EPS grew by 38%. Their Google search business grew revenue by around 12% or so. The Google Cloud business grew revenue by about 30%. So the thesis for Google is extremely simple. I hope that they can diversify out of search into other revenue streams like Google Cloud. They have Waymo as well coming up for them, as well as YouTube. So YouTube is an amazing business. It's been growing 14% over the past few years. Google Cloud is growing at 30%. If you look at AWS is growing at around 19%. So you can expect the 30% to drop to about 19%, but that is still amazing for Google. So if you look at Google's valuation now, I projected around a 13% EPS growth over the next 5 years. So that will equate to around 11% of real growth and then 2% of buybacks. So Google has most of its free cash flow going into buybacks, and the buyback yield is around 2% every single year. So if you look at the grand scheme of things, you have a company trading at 22 PE. It is relatively cheap in comparison to the market, and trading with an EPS growth rate of around 13% forecasted over the next few years. That is extremely bullish and cheap for the company. So I did some valuation. I put Google Cloud at 30 PE. I put Google Search, Google YouTube, Google Services at around a 22 PE. And I got an intrinsic value for those two of around $192. So that means that you're getting Waymo, you're getting xAI, you're getting all the quantum computing ventures for extremely nothing. So I think Google is an extremely compelling buy now. You might want to consider it. Next stock that I'll be talking about is ASML. So ASML is the company that makes the machines that help to make your AI chips, your normal day-to-day chips that you need for all your microwaves, your cars, your phones and all that. So ASML is essentially the backbone of the semiconductor industry. So you have your semiconductor industry like this. You have NVIDIA designing the chips, you have TSMC making the chips, and then you have ASML producing the machines that help to make the chips. So without ASML, this whole ladder over here cannot function. So for ASML, the thesis is like this as well. So there are two different theses that I have. One of it is just the AI revolution continue growing, and it is the most predictable way for you to participate in AI, because all your different AI LLMs, all your different AI, basically all your different chips, they will be commoditized next time. Meaning to say the demand for it will drop because it will get so cheap that basically no one needs it anymore. But for ASML, if the chips get cheaper, the demand for your ASML machines will still be there, or it will be higher as well, because you still need the machines to produce the chips. Next thesis. So the next thesis will be that the US will deglobalize all the foundries into the US. So in order for them to do that, right, they need to incentivize all your different companies like TSMC to move all the foundries into the US. And when they move all the foundries into the US, then ASML's revenue will go up. So if you look at this company over here, it is projected to grow about 20% in EPS over the next few years, and that is incredible for this company. It has one of the most amazing moats out there. So basically, like let's say you sell a machine, so ASML sells a machine. So when ASML sells a machine, they will sell other services on top of that as well. So you need your annual recurring, you need your services, you need to have manpower over there from ASML to help service the machines when they come down, and those are your recurring revenue streams for ASML as well. So ASML mainly sells two different machines. You have your EUV machines as well as your DUV machines. DUV machines are used to make all your different day-to-day items like your phones, your cars and all that. The EUV ones are used for cutting edge AI chips for your data centers, your cloud computing and all that. So ASML is the only company in this world that is able to produce the EUV chips using their machines. So there's no other company in this world that is able to produce such machines. So on the grand scheme of things, if there was another company coming up with EUV machines, they still won't be able to take over ASML's share, because all these foundries, right, they already built the labs to accommodate the ASML machines, and it will cost more than expected to tear it down and then accommodate the other company's one. Last stock that I'll be talking about is S&P Global. So S&P Global has mainly three different revenue streams. They have their credit rating services where they will rate all the different companies and then credit quality, as well as the analytics business where they provide data. And then the last one will be their index business. So for S&P Global over here, the credit rating business, they are the duopoly. They hold a duopoly with Moody's, and about 75% of the business of that credit rating business is recurring revenue. So they have to do monthly and weekly and I think yearly checks on all this company, on all that credit and all that. And then 25% is affected by your debt issuance and your debt maturity and all that. So on the grand scheme of things, that credit rating portion is still quite predictable as well. Next one, you have your data service, you have your data revenue stream. So for S&P Global over here, the data revenue business has been growing for about 7 to 9% every single year. And that is extremely predictable for this company. They own Capital One, they own all your different other commodity insights and all that, which provide data for all your futures and all that. So this portion over here, all you need to do is just grow 7 to 9% every single year, and you can grow earnings by about more than 10% every single year. That's predictable. Last portion that they have is their index business. So I'm sure you know your S&P 500, your Dow Jones and all that. All of those are licensed by S&P Global. So what S&P Global does is they will accommodate all your different stocks into one bucket, and then they'll sell that license and that brand to all your different ETFs, your ETF issuance companies. So for S&P Global, they have no direct credit risk. They have no direct asset under management, so they have no risk to the AUM. So of course the AUM will affect their earnings because those fees are tied to AUMs. But if you look at history over the past 10 years, the only time where the AUM dropped was in 2012. So even in 2020 crash, even in 2018 crash, even in the 2022 tech crash, the AUM still went up. So the earnings from that portion will still keep going up even though the market drops.